So Phil, you've been involved in disruptive tech all your life, a 30-year career. You've done 5 investments into early tech startups. I was interested, given your knowledge in the industry, your history, what have you seen as being the most disruptive time in tech?
Interesting question, Debbie. So my career started out actually 40 years ago selling typewriters. So that was the disruptive technology of the day, the golf ball typewriter. And then my first business was selling word processors. But if I look back, I think the most exciting time was really the very early days of the internet, what I refer to as the dot-com days. Because that was a real game changer. That sort of influenced our lives. So, the internet has sort of changed our lives so much. And to be involved in that very early days was really exciting. So I had a business building online stores, sort of the very first sort of version 1 e-commerce shops. And for about a year, we really struggled to persuade people that they'd sell their goods online. But as we know, it all came good in the end. And we ended up building the first e-commerce sites for lots of well-known UK retailers. And as we know, many of them now get more business through their internet site than all of their retail stores. So that was a really exciting time. So I've seen some really exciting new tech over the sort of 30 to 40 years I've been in the industry. And what I try and do is really spot a new trend and sort of get in early, ride a wave and find some technology that we can bring to market and sort of disrupt the status quo.
Because you were one of the first people to launch a flex platform, get involved in auto enrollment, so you've always been sort of at the forefront of what's happening on tech, particularly in our market.
Yeah, we launched our flexible benefits platform about 2002, so that's very early days of flex. And we were first to market in 2012 with a workplace auto-enrolment pension platform. So yeah, they were good times.
So Phil, this brings us neatly onto your latest venture, Smartly, which, as I understand it, is an online savings and investment tool, sort of a robo-advice type product. What was the opportunity that you saw in Smartly?
So I was already invested in a number of fintech businesses. And businesses in the sort of the wellbeing space. So I was very alive to the opportunity or the level of interest in financial wellbeing. And I got introduced to the founder of Smartly, a chap called Ben Pollard. Ben's an actuary and he spent most of his career advising large insurance companies on their investment and risk strategy. So he knows a thing or two about investing. And the background to the business is that Ben went to get himself an ISA at one of the sort of well-known financial services websites. And in Ben's own words, he was appalled at the experience. He was bombarded with fund data, fund fact sheets, opinions. And he thought, well, this is complicated and I'm an actuary, I know what I'm doing. How does the average consumer cope? So he set about building a platform to make buying investments as easy as shopping on Amazon. So that was the background to the business. And I had a good look at the tech that Ben had built. I really liked it. And I just saw an opportunity for us to bring about change in financial services and in particular around workplace savings. Because we think change is really needed. Enough people don't save. It's something like 16 million people have less than £100 in savings. Over half the workforce in the last year have borrowed money to pay for basic needs. So they're just getting more and more in debt. So I just saw an opportunity for us really to try and bring about change, improve the financial well-being of the UK population. And also we've seen this sort of shift towards people using these online, as you called it, online robo-investing platforms. So I saw this as a really exciting opportunity, another sort of potential disruptor in the market. So that's what we're setting out to do, bring about change in workplace savings and disrupt the status quo, really.
So surely there's a whole financial services industry out there, all geared up to give people advice. How's a platform going to do better than people and face-to-face?
So yes, there's a big industry, financial services, but it shrunk over the years. There are now fewer financial advisors, and there seem to be fewer every year. So there's not enough advisors around to support everyone. It's typically the higher net worth individuals are benefiting from the service of individual personalised financial advice. So we see platforms like Smartly as a way to sort of bring financial education to the mass market and help educate people, help encourage them to take action, help them make more informed decisions about finances generally. So in some ways, we look at it that we're going to sort of complement the financial services industry, support what they do, but also bring financial education and guidance to the mass market so everyone can get served.
It's all about affordability, isn't it?
Yeah, exactly. These platforms usually are much less expensive than you would pay if you were getting personalised financial advice. And I know that from experience. I've got a financial advisor, he does a very good job for me. But more recently, I've started putting my finances on the Smartly platform, of course. But I find it more engaging. You know, I've got access to information on my phone through an app. So it's much more engaging, it's more accessible, and it's less expensive as well.
So over the last year, we've seen an enormous shift among REBA members. The interest in financial well-being has gone from them just talking about it, which was happening for quite a while, to now we're seeing them actually actioning it, investigating it, wanting to do something about it. Why do you think that shift has happened?
I think what's driving interest in financial well-being in particular, and more money I think is spent on financial well-being than on any other well-being product, particularly around pensions. You know, as a minimum, employers are spending 3% of salary on pension contributions. Many of them are spending more. And I think there's growing recognition that they're not getting a good return on investment because people don't recognise the value of what's being put into their pensions pot. There's a lot of research that supports this, and I read some recently that said 39% of people didn't know they'd been auto-enrolled into a pension scheme. 80% of them got no idea how much is in their pension pot. So pensions just aren't really working as an engagement tool, so I think people are looking for something different, something better. And two things that are really driving interest, and the conversation that we have with most employers is millennials just aren't really engaged with the pension. You know, it's too far out. You're talking about a benefit they might not see for 40 years. And very soon, millennials will make up 50% of the workforce. You know, by 2025, it would be 75% of the workforce. So rather than putting all of their money into a pension pot that they're not valuing, why don't we divert some of that into a savings vehicle that gives them more flexibility, you know, to save for their first home and all the other life events they've got to save for. So that's a big driver. And then at the other end of the sort of the pay scale, if you like, there's an increasing number of higher earners who have been impacted by the reduced pension allowances, both the lifetime and the annual. So employers are looking at what alternative tax efficient savings products can they provide them, as they can no longer receive the company sponsored pension contributions.
Can I add a question to that? So, as I understand it, what you're trying to get, especially millennials, into the savings habit. You're not saying that they shouldn't save into a pension one day, because I don't think any young person,
no, not at all, no.
at any, even when we were young, weren't that interested in pensions. Yeah. It's getting them into the habit so that becomes natural that they're going to save for the long term, rather than instead of a pension.
Absolutely, and thank you for picking me up on that. Pensions are a good thing, and everyone should have one, and everyone should save into a pension. So you're right. We're trying to encourage better saving habits, and the workplace is a good place to do this. So if you can encourage and help people to save through the convenience of payroll deduction, and if you're matching contributions, they're all good incentives to get people started on that savings journey. We just feel that, of course, saving for retirement is important, but what about all the other life events along the way that people need to save for? And if they've not saved for them, they're just going to get more and more in debt when they borrow money to pay for those events. So we just think there needs to be a bit of a shift, a bit more of a balance and one overall savings pot really with different jars for different sort of life events, short, medium and long term.
We've seen a huge amount of change in financial services, in banking, disruptive banks, just the whole financial services fintech industry seems to have been turned on its head in a relatively short time. And as you said earlier, Smartly is being disruptive. So what are some of your plans? What are some of the things that you're thinking about working on now that will take that forward and continue to be disruptive in our market?
Yeah, we think ourselves as a challenger provider. So as you referenced, a bit like the challenger banks, they've really changed the whole landscape of the banking industry. And we want to do the same with workplace savings. You know, we want to sort of disrupt the pensions market in particular. And we understand that the market wants that as well. So we recently commissioned some research, which we'll be publishing very soon, where we spoke to a few hundred businesses, and we asked them questions about their pension scheme and what they felt about it, and the savings marketplace generally. And overwhelmingly, the majority of them said they want to see disruption in the pension space. You know, it's just time for change. Pensions really haven't changed very much at all for tens of years, other than changes in regulation, but actually the whole pension product, the way it's communicated, the way we onboard people, it's not changed much. So, you know, we really do want to disrupt the marketplace. Our research also found that about 90% of the companies we spoke to do intend to review their pension provider, and they would welcome a disruptor coming into the market. The size of the provider wasn't a high priority. You know, they value things like the user experience, modern technology like apps. Those things are much more important than just going with a big provider. So we do feel there's a good opportunity to bring about change in the marketplace. At the moment, Smartly is focused on providing individual savings accounts primarily, so ISAs and general investment accounts, and we've not gotten involved in pensions. But a lot of our companies are asking us, why can't we use your tech to manage our pension scheme? Because it's much more engaging than the legacy technology that we've got already. So I think you know, it's time for change. I do believe that across financial services generally, we will see new challenger providers coming in, and we will see a lot of disruption. And I think the pension providers of today, you know, they've got to ask themselves, you know, do they want to adopt modern technology and disrupt the market themselves, or do they want to be disrupted?
Mm-hmm. Really good question, and I'm hearing that from other places across the industry. We are going to be seeing interesting times ahead, and that's not often a word that you associate with pensions, so good luck.
Thank you very much.